what are the things that we should be asking in navigating this process?
There's a lot of intricacies that go into how we come up with that interest rate.
Everybody wants transparency.
Always be consumer advocate first.
So stupid questions get stupid answers, and we're going to talk about the dumbest thing you can ask when you are trying to get a mortgage. I'm here with Jason and Rob from Rate.com. Guys, what's the dumbest question people can ask?
Yeah, sadly, it's the question we get 10, 15 times a day is, what's your rate? Right? It's a very loaded question. People are just trained to naturally want to shop and think that that's the right question to ask, but there's a lot of intricacies that go into how a rate is how we come up with that interest rate.
It's a dangerous question.
So I like danger. I like to live dangerously. So, but in defense of folks that are about to shop, like ultimately, isn't that the most important thing? Is what I'm paying? It's going to define the cost and all these different things. So, why is it not the best question when I'm approaching the lending process?
Sure. So depending where you're at in the process, when you're actually under contracts, that's when you're actually able to lock in your interest rate. Until you get to that point, no lender is bound to give you the correct information. So if you say, what's your rate? Well, I know you probably, in the Philadelphia region, you're probably asking for a 30-year fixed rate with no points, but that's not what you asked. What's my rate? I could tell you an adjustable rate, and I could tell you a 15-year fixed rate. I could tell you with 3 points that you're paying. So it's just as vague a question as can be. And without knowing everything about you, it's an impossible question to answer. And it's impossible because especially if we don't have your information, we don't know what your needs are, right? And what type of term do you want? How much are you willing to pay for that rate? And so it's just opening the door. And sadly, we come from an industry that, is coming from 2008, 2009, being one step above a used car salesman sometimes. We come from an industry that has some dirt in it, and you have to really weed through that. So if that's your initial question to a lender that you have no idea of their qualifications or anything like that, you're setting yourself up for danger.
And that's why it's a dangerous question, is you have to talk about your costs. So when you get that question, I think we're good guys, but there are trained professionals that know exactly how to manipulate that question and make that borrower feel really good about the answer to that question, which was not the most well-rounded question. And they're trained to do exactly that, twist and turn it, where you leave that borrower leaves that call. Oh man, that's where I might get my best deal. When in reality, there's one simple follow-up question. Hey, can you give me a detailed breakdown in writing, please? And then listen for that answer. And that'll be a much different answer.
I love it. I love getting into the solutions. And I think that, so just to put a pin in that for a second, because I know we came in pretty hot and heavy with the stupid questions thing, right? Intentionally to hook people. But I think that the big takeaway is the reason that it's not a great question is because when we think, everybody wants transparency, right? And I think that the irony is that when someone is behaving transparently, when the lender is behaving transparently in that situation, they're actually probably not, right? Because there are more questions than there are answers. So that's why it's a dangerous question. So let's get deeper into that, Jason. So what are the things that we should be asking and in navigating this process?
Yeah, I think come across as an informed consumer, where there's a multiple factors that go into what is my rate. So I think you can lead off with a question that goes something like, hey, I've been monitoring my own credit. My credit scores are great. They're over 750. I'm putting 10% down on my first primary home, right? I'm a first-time home buyer. That's a very big deal. I'm a first-time home buyer. I don't want to pay, what's this? I need to understand mortgage insurance. Can we talk about what the best type of loan that I should be getting, right? What's the best loan? What's the best loan structure for me? You have to have those conversations of what are your goals? If they're not asking you about your greater financial goals, you're about to take on this giant piece of debt that you're going to have, most likely until you take your next mortgage. So yeah, I think you have to dig deeper with a couple of those questions that set up your loan officer really well when you just state a couple of those facts. I know my credit a little bit because I've been preparing for my home purchase. I know how much money I have to use. And that's actually a great catch there, that maybe you don't say down payment, just say, hey, I have about this much to use to buy this house.
Okay.
because you have closing costs that are built on that. So right away I know, okay, they have this total amount. Where I think a common mistake that is like, I want to put this much down, and then we drop 3 to 5% of the sale price in closing costs in Philadelphia, and then like people are falling off chairs.
Got it.
So I think it
There's
is also
there's
just like,
other-
hey, how much I have about this much cash, I have this much credit, I have this much down payment, and then I would also just mention I'm buying a home, I'm buying a condo, and that gives you, I think, a really good head start. I don't know if you have anything else to.
Right. No, the two most important questions or the answers that we really need to help guide somebody: what's your monthly payment comfort level? And then how much money do you have to utilize for this transaction? And then we figure out what should go towards down payment, what should go towards closing costs. Because if you're buying in the suburbs versus Philadelphia, different closing costs.
Right.
And that's really, those are the important questions that hopefully somebody has thought about before, not what's my interest rate. Because if you want to buy a $600,000 home and you want to be at $2,000 a month, it doesn't make a difference if interest rates are at 3%. You're not getting to $2,000 a month.
Yeah.
So that's really the most important thing for us, to really be an advisor and help somebody, because the rates, we're lenders, we have our rates that we set, but there's bigger factors that are really guiding where interest rates are going. War breaks out. A new Fed chair is coming in a month. These things are going to have massive impacts on interest rates, not what we tell you it is. And what we tell you today versus when you go under contract 2 months from now, doesn't mean it. So it's really just, and that's where, again, you can be set up for some manipulation. Somebody will say a rate that they are not bound to. A lender will say a rate that they're not bound to, just to get you to call back.
Yeah.
And it just doesn't set up for a transparent transaction from the
And you know what? In a perfect word of transparency, I think a quick tip is that we are a bit of a commodity in the well-qualified space, just meaning that like your lender should be within about a 3/8 of each other, depending on how big they are, how small they are, how much it costs them to write a loan, how many underwriters and processors and all these things they have to pay us. And I think it just is a matter of fact where it's okay to talk about that, where, hey, look, if somebody's telling you something, if it sounds too good to be true, it probably is. That's all.
No, that makes total sense. I feel like we could, go on the clickbait route, right? Of going, okay, so what are the 5 things that if I hear these, I should run for the hills? But I'd rather go from a proactive perspective, because I think the main thesis here is, look, if somebody, in most other industries, if somebody's coming to you and giving you, a sort of roundabout answer, or going like, hey, I can't answer that because there's 85 variables. A lot of times people's instinct is to go, well, you are gatekeeping something. But in the lending space, that is probably the pathway to a virtuous person, right? That's actually going, there's more details here before I can promise you anything. So I would say, I don't know if there's 1, 2, 5 things that when you're talking to a lender, instead of going to the negative, let's go to the positive, right? What are the things that your team does? What are the things that you do when you're working with folks? What questions are you asking? And what are those steps that a person should start to build comfortability as you go through it?
Right. So what we like to do is we keep it interactive. The conversation doesn't stop at your pre-approved. That's just the beginning, right? You're pre-approved. Go out, look for homes. When you see a place that you think piques your interest, that you might want to make a run at, let us know. Shoot us the address, because property taxes are going to be important. The type of property is going to be important. If it's a condominium versus a single home. So there's so many, again, all these variables. So once you find something that you think you like, once you're pre-approved, let me know. Shoot me an address. I'm going to run all the numbers that you need to see, so that before you sign a legal contract, you and your agent are able to review everything. We make sure that it's hitting all of your targets, right? That you're comfortable with the monthly payment, that you're comfortable with the cash that you need. Again, it always comes back to those 2 factors. And then you go and sign that legal contract. So it's really just, the pre-approval is just the start of it, so that we can then start the deeper dive and show you some real hard numbers.
I mean, a lot of time it's a formality, right? The pre-approval is a formality. You're out being serious about shopping for a house in the vast majority of experiences, that they're ready. You're ready. The borrower's ready. They're prepared. They have enough, especially today with all the resources a consumer has. They do come in ready, and I think it's also, I think one of the positive parts about educating. And I think one of the things I would say is, it was the words you almost used, is we have a constant theme is just next steps and expectations. It's a subject on our email. And that's our pre-approved email, is like, now here's the thing you needed. This was pretty easy for us. We can do this in like 8 minutes.
Right.
Here's some next steps and expectations. And then we kind of go into that, like, hey, we work all the time. We know you're on the weekend. Like, you have a job. You can't be looking at houses at 10 a.m. on a Tuesday when I would love you to hit me up and I'm sitting at my desk on a calm. Like, no, we're used to that. We know that. And we want you to reach out to us so we can make sure in that specific offer we're dialed in. And I think it's like, we can get into the minutia. And I think the beauty of our industry is I can show you. Is if you want to see the little grid, and I'll bore you to death, and I've done it with plenty of engineers, accountants, financial advisors, all the love to those folks, but they're very detailed. They want to see it.
Yeah.
So, hey, I'll screen, here you go. Here's the loan level pricing adjuster grid. You know, that my painter client would be hard. They don't want to see it. But hey, you want to see, here you go. And I can itemize every single thing. Here's the little adjuster for your credit score. Here's a little adjuster for the condo. Here's a little adjuster because your income is $208,000 versus $87,000. And yes, in the world today, you actually get a little bit of a better rate if your income's lower, because you get some of these subsidies for being a first-time home buyer.
Got it.
So I think there's just a lot of these things. The good guys don't want to know details and minutia to be negative. We want to know, so we are absolutely certain that we're getting you that best loan structure, the best rate. Maybe there's some down payment money. There's all kinds of things now that, you know, I think some of the little irony of rates going up and some of the pressures that the buyer's under, they really do have the most options in the history of mortgage lending.
Wow.
You know, and that's a fact right now.
We sell that. So I'm somebody that doesn't even like to rent a car because it's not mine, right? So like, I'm selling hundreds of thousands of dollars of debt to somebody. We want to be responsible with it. We don't want to, you know, come off as sharks, or that we're trying to push something that you are not comfortable with. So it's really just responsible lending that we try to preach. And, you know, there's a story for every loan, and some, you know, we see a lot where a couple buying a home, one spouse has worse credit, so we're only using one borrower as opposed to two borrowers. So it's not giving you the, you know, their debt to income ratio might be a little higher, and it's not giving you the true depiction.
Sure.
But again, we want to make sure that you're making a responsible decision. And in this real estate environment where there's so much pressure and competition, and you know, sometimes you have to make hasty decisions, and we want to make sure the loan is not one of them.
I love that. Something I noticed you said a couple times, Rob, is you didn't use the word what you can afford. You used the word what you're comfortable with on the monthly. What's the difference? And I know I'll go back to my fun hook, right? There's a lot of what we would probably classify as a dumb question, which is, what can I afford? And why is that a dumb question? And what's the smarter question? And what's the reason for that?
Yeah. You know what to say?
I mean, it goes back
That's
to
Jason
the,
laughing already.
well, it just goes back to the trained professionals, right? That will max you out and frankly make you house poor. And it just is simply, just because I can get you that loan doesn't mean I should. And I think when we evaluate what type of loan you get, a couple quick factors, we're using gross income, right? So right off the bat, I don't know anybody else that takes their gross income home. The self-employed folks still have to pay their taxes at the end of the year too, right? So your net income, you know that, I don't. And I don't care. We don't care to know it in the lending business.
Yeah. I mean, it's crazy to think that you couldn't do anything in the business world, right? Like, I have a video production company here. I can't operate solely off of gross, right? It doesn't make any sense, because you don't actually have all that cash. So have you seen those horror stories?
Yeah, so that affordability where that other professional is going to leverage you up, where, you know, they are going to be reckless, because at the end of the day, listen, we do get paid on loan amount. That is still, even post Dodd-Frank, there's very strict regulations on that. But at the end of the day, you could possibly be earning more in a higher loan amount. Now, that's not going to be a motivation for a lot, but yes, there's still all those out there that are doing that. And why I'll never understand. And I think Rob would certainly agree, and I'll kick it over to him, is like, I want to do that family's mortgages for good. Like, why would I take one loan when I could be really, and sure, it's like, it is having integrity and doing it right, but it's like, it's also just good salesmanship.
Sure.
And I think when you start to back up a little bit and show people, hey, you'll run across someone that'll give you that pre-approval of that $880,000 house, 100%. You'll find them, make a couple calls, but listen, here's why you should not do that. And I know that's a beautiful house. You will regret it within 4 months. And I do talk to folks like that. I think Rob's a lot wiser, maybe a little bit, a little bit craftier with his words, a better wordsmith than I am. But I think it's just about also being pretty upfront with people too.
You don't open Rob with like dumb question. Like, that's not your move. That's
The industry, like every industry, has guidelines that we operate, and those guidelines will often allow, if you have excellent credit and you are a W-2 borrower for a company that you don't own, and you're not buried in consumer debt, we're going to be able to usually qualify you for way more than you want to spend. And that's what the industry allows for in their guidelines. But as I say many times every single day, mortgage guidelines and real life don't always coincide, right? So you just always want to make the responsible decision for you and your family. What we see on a credit report is not what you're spending your money on every day. We are not seeing how much you spend on groceries. We're not seeing how much you spend on, to fill your tank up. We're not seeing how many times you're filling up your tank a week.
You may want to go out to dinner.
Exactly. How many times you like to go out to dinner, vacation, what your savings goals are, any of that. We don't see any of that. So that's where we really, again, all of this that we're talking about
Next level
has nothing to do with interest rates.
That's got to be really important. No, for sure. It's got to be really important. I think I just want to hammer that home because I've been through the buying process before. And I think that you almost have this assumption that like when I'm sending you over my tax documents, my paperwork, that the lender has this like microscope and they know in crystal ball, and they can predict exactly what you can afford, right? But
shout out to Dave Franklin. He does. He's magic right there.
Dave, wherever you are,
just right. Shout out to the.
What am I going to say next? What am I going to say next, Dave? He knows. He already knows because he can see the future. But for everybody that's not Dave Frankel, right? You won't be able to see those things, and I think there's this misunderstanding that, hey, you have all my data, right? And you don't. You're operating within guidelines. And I think that's really important for people in making that decision. I want to ask, and maybe this is too speculative and outside of your guys' wheelhouse, but like, even especially in the wake of 2008, which, like I kind of started in this working world, right? A few years before 2008. So people don't know. It was like a really scary time. It's odd to me to think that that's still permitted the way that it is, right? That you could sort of max out that way. Is there a reason for that? Like that, people are being speculative a little bit and we want to create some opportunity for that. Like, why is that there's still this sort of.
I was not prepared to talk about government policy.
Yeah, you don't want to hit that?
But I'll jump into that.
I think you're well.
Put the mic closer, Jason, so we can really just like blast this all over TikTok.
Look, I also think it is worth clarifying. There are really strict rules. There's an ability to pay rule now that comes out of that Dodd-Frank. There's very strict rules, as we talked about early on with interest rates. There is a max cap, no matter what kind of creep is going to charge you or something. There will be eventually something that comes in and says, no, there's a max, but it's 3 to 5% of the loan amount. So a bit expensive still.
Yeah. So
there are absolutely safeguards that came out of that. I think it was 2010 legislation enforced in 2013. I just think it's a little bit more about taking advantage of maybe even the borrower than it is taking care of an underwriting guide or taking advantage of an underwriting guideline, just meaning that they truly don't know what they can afford, right? Yeah. It's not that you're writing a bad loan. It's that like, you're not asking that next level question of like, hey man, do you eat steak 4 times a week?
Right.
Or are you, banging the Happy Meals?
Right.
And that's a ridiculous question that I don't ask, but it's like, you get the point of like, hey, you really got to understand what the family's doing or what the people are doing.
And if you're hitting all the Happy Meals, you got to like, what are your medical expenses going to be?
There's always a yin to the yang, right? But no, I think it is just about setting that up. So I don't know if you have any other thoughts on that.
It's there are, like Jason said, there are safeguards. A lot of the loans that existed that had these toxic traits fell by the wayside overnight. And it was in 2008. We were both in the business, well into the business, and we used to have 30, 40 subprime reps come into our offices every week. Subprime, being these less optimal loans, and overnight it became zero. Like the whole side of the industry just died. And so now over time, as regulations start to ease and we get further in the rearview mirror from 2008, some of these, there are certain loans that do make comebacks from what they used to call Alt A, or like these, like not stated income, but using bank statements to qualify, things like that. Like still within these ability to repay rules, but just outside of your traditional Fannie Mae and Freddie Mac guidelines.
Okay.
So they start to make a comeback, and you pay a little premium for those types of programs. But the second that you start to see foreclosure rates tick up on those loans, then they go away real fast. So, but we haven't seen that. So.
And I think it's a good topic. We can stay high level without boring too much of the masses. You do have a situation where you have a more restriction through the government lending because of those rules.
Yep.
And it was smart and it's good. So it's taken 13 years, but over the last 5 or so, but especially the last 2, you do have these portfolio lending products now.
Okay.
Right. So why the government has narrowed that pool of loans that they want, and they've been abundantly clear about what that is, and it's really first-time home buyer, primary home, W-2, safe stuff. So what I love is the private market has stepped in now. So those types of products, also a lot of old school mortgage folks that learned from that mess and went out of business and did this stuff and said, okay, we're not going to do these liar loans and these other things, but hey, we can be really smart about this. And now all of a sudden you're using AI to develop these types of incomes, and you're using these. So I do want it to be clear, like I don't think I'm biased because I take a lot of pride. I do come from an operations background. I don't think it's reckless at all. I think it's actually, for the first time in a long time, it's really smart borrowing. And the best mortgage that has come out of that destruction is that it took us 13 years, maybe 10 years to really put back on the street things that will bring great value to self-employed folks, maybe that run a cash business, these different things that, like, really, they should be homeowners. There's no reason that they should not be homeowners. And it was because of technicalities they weren't. So I think it's a very safe space, but yes, can you be taken advantage of? Of course. But it should be the outlier with a lot of the rules that those big time housing regulations took place.
I definitely can say attest from personal experience and being self-employed that the first time we bought our home in the city, and then we ended up moving to the suburbs, and the difference between like just where I was as a business owner in terms of my accounting and the accountant I was working with versus the bookkeeper I was working with before, and just like the systems I had in place made that process so much easier. But like compared to my wife who just provides her W-2, it was like done. And there's all this documentation and then redocumentation and the double check and the updates and all those different things. So it's so complicated for somebody that doesn't do that every day. It's good to hear that there's some avenues for opportunity. I want to ask you, and we can cut this if you're not allowed to talk about it, but do you have any of those, like, you've talked about these maxed out loans, have you, and people that maybe are spending what they can afford, but not what they'd be comfortable actually paying. Have you heard any of these, the internet loves horror stories. So like, are there any of these horror stories where you're getting like calls afterwards or going like, somebody else gave me this kind of predatory loan. I'm like, really, I'm 4 months in and I'm really anxious. How do I get out of this? Or like, I'm reaching out to you and you're like, hey, I know you got this rate and for this amount of money, I would not move forward, in kind of those hero stories where you've kind of helped people out. Do you have any of those sort of anecdotally?
Yeah. So, I mean, look, the refinancing that occurs now primarily, well, for the past year up until the last couple of months when rates started ticking down a little bit, but the only refinancing you were doing really was coming out of divorces, right? So you had to get one spouse off of the loan.
Situational refinance.
Situational refinance.
I like the hands too. I eat the fist.
It's the Italian. I can't help myself. I should have never said it between you guys.
Back in 2010, 2011, when people were really going through it and the employment rate was awful and everything was awful, right? There were lots of, people, the threat to lose the house and how do I worry about my next payment, and these modifications started, and as the modifications started, then there was fraud in modifications, and but now you do. Oftentimes, it's people that sort of thought, hey, we think rates are going to come down, so we'll take on this payment for a couple years, and unfortunately, everybody's gotten it wrong, and they haven't come down yet. So you get that a little bit, but that's where again, it's one of those questions: how much money do you have for this transaction? Because we also don't want you using every single penny you have just to get $1,000 loan amount or lower loan amount. $1,000 on a loan is about $6 a month right now.
Really?
So would you rather have $10,000 more in the bank just as a
Buffer, yeah.
a buffer, a rainy day fund? Would you rather have that or $60 a month less payment? And especially if you don't have other backups, you don't have retirement plans or anything else that you can bank on, you want to keep that rainy day fund. So that, again, we just try to be responsible with everything overall. If somebody comes in, they say we want to put 10% down, great. Well, you have the closing costs too, and so maybe we should look at 5% down plus your closing costs, and it gives you a little bit extra. And as long as you're comfortable with the payment, we go there. So you don't hear it as much, but look, you hear this overall debt, like personal debt crisis looming,
Right,
things
right.
like that. Like car payments are at all-time highs. So pain is real. It's just getting it out of your house isn't the same, where people aren't using their house as an ATM as easily anymore.
Right.
So.
I love, by the way, just I feel for people listening, especially if you're a first-time home buyer that's never been through this experience. There's been a bunch of examples, and I think if you've never bought a house before, go back through and listen in this conversation, because there's been a couple, like even you just as an aside just now, Rob, throughout that example of what that conversation, hey, I got 10%. Well, maybe it should be 5% in this, and that differentiation, which is what this whole episode was about, between, lenders that have your best interest and maybe lenders that don't. And not even to say it's intentional, just aren't thinking about that when they're processing a loan. And I really love those examples. I want to ask you one last question before we hop here, which is, you guys mentioned that you sort of were in the thick of it in 08, right? Like I was, I graduated college in 05. We started, I incorporated this business in 08, right? So I was, I kind of didn't have much of a framework, frankly, right? Of just what, it wasn't like I went through good times and then into bad, right? It was like they just started out with, I have no idea, and then we're going to build this. So for the folks that started in that crisis, it's almost like you didn't know what you didn't know. But for folks that kind of went into it, and especially that were so close to the core of the crisis, were there formative experiences for you that you think, frankly, set you up as a better lender today because you went through that, in terms of what your capabilities are, and having gone through that, forged through fire?
The mortgage banker, the people, was forged out of that. And that's was funny because a great mentor, another shout out to Larry Cohen, but he was across town doing more dollar volumes of loans, but less units of loans. And we would compete pretty hard. And it was a mortgage banker, the people was at the same time of like, oh, are we in Rittenhouse right now? I got to be careful. Like, oh, the fancy folks over Rittenhouse, and we were down like Society Hill. Not that that's cheaper, but we were doing that particular real estate office was just a ton of units.
Yeah.
Dominated Philly at that time, and the Occupy Wall Street stuff started, and I started reading more, and frankly, was horrified to learn about fractional reserve banking and all these different technical things of really why that went down the way it did.
Yeah.
And then to actually find that there was a number of people, the large percentage of bankers that absolutely were jumping up and down, screaming and yelling, this is coming, this is coming,
Yeah.
this is imminent. And so trying to learn from it all, I think it was more of that persona to always be consumer advocate first.
Mm-hmm.
Being at what we call an independent mortgage banker, we are not a bank. We sell against banks all the time, and it was easy to sell against the evil big banks at that time. So it was a bit of a layup, but it's also about, being local, right? Being kind of locally trusted, but having this big national presence to be able to get through something crazy like that, but also be able to kind of use it to educate of like, hey, here's why you don't want to do that. And then have some of the war stories, which are, there was a lot of people left at those settlement tables with wires that did not show up to none of their own accord. It was just a technical thing, and it was jarring. So I don't think if you came out of that learning, I'm so curious to hear Rob, because I know he was in a different realm at that point too in his career. But if you did not come out of that learning something significant and permanently changing the way you operate as a mortgage professional, well, I think it's easily said you're not in the mortgage business right now, in my humble opinion.
Yeah. Yeah, no, it was chaos on the outside. day to day, loans still happened. The guidelines were slightly adjusting. We had to go through a whole bunch of licensing now. Before we weren't licensed, and then we had to get licensed. But the day to day remained the same. And then, as things progressively just started to get further in the rearview mirror, everybody got more comfortable buying. We see how prices have gone in the past 15 years. I mean, it's the prices of homes just continue to increase or appreciate. What keeps us viable, like Jason said earlier, is we want to do the parents loan. We want to do the kids loan. Like, we're not here to be a one and done and take somebody to cleaners
loan,
and then that's it. Never see you again. We want to show up at the settlement table. We want to be there with you through that experience, because it makes us feel good that, hey, you came to us. We know you're being taken care of. We know that you didn't get a raw deal, that that things were transparent. And just the more loans that we see and the more loans that we work on just make us better loan officers. It's 99 out of 100 files aren't stumping us, right?
Yeah.
It's just very similar things that are happening. Everybody's a little unique, but it's similar concepts of how these underwriting guidelines are framed. Every now and then you have something a little unique, which is really more related to like self-employed and a couple extra schedules on tax returns and things like that.
government loan.
But it's nothing that you can't figure out and that there's no guidelines for. So it's so just the more loans we work on, the better we are at our jobs, and the more we've seen, and the more we're just easily managing a transaction.
I love that that answer, because it really just kind of indicates, we've been there, done that, and can do it again, right? I think this is a great episode. I know we came in kind of in a fun way with what are some dumb questions that people are asking, but I think that the answer, even though I'm looking at the clock here, we're at 30 minutes in, that
Wow.
the time it takes to explain this properly to someone, if someone is taking that time, that usually means in the lending space that they have your best interest at heart. Jason, Rob, thanks so much for coming on.
Thank you.
To Beyond the Frame. Thanks.
Appreciate it.